want to uncover the secrets behind 9 impactful phrases from successful investors who have generated astonishing returns? In this video, we present strategies and advice endorsed by some of the world's most successful investors with a clear goal to help you boost your earnings and achieve exceptional profitability in your investments. Are you ready to learn from the best and take your investments to the next level? Let's get started. Warren Buffett. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Warren Buffett's statement refers to the importance of preserving capital and minimizing losses when investing. It underscores the significance of risk management and capital preservation as essential elements for long-term investment success. Avoiding significant losses is key to achieving above-market returns over time. Imagine John, a young professional who has been working tirelessly to reach his financial goals. His most cherished objective is to buy his own home, a dream that motivates him every day. However, one day, a friend presents him with an incredible investment opportunity in a technology company promising astonishing returns in a short time. Motivated by excitement and success stories he's heard, John decides to invest a significant portion of his savings in this company. Unfortunately, the company fails to deliver on its promises, and its stocks plummet due to internal issues and mismanagement. John finds himself in a challenging situation. He has lost a substantial portion of his hard-earned savings. John's story is one that may resonate with many of us. Losing money in a bad investment is more than just watching numbers disappear on a screen. It has a deep emotional impact. It generates stress, anxiety, and a sense of regret that we've all experienced at some point in our lives. Furthermore, this financial loss directly affects his personal and financial goals. John's dream of buying a house is slipping further away. This situation can apply to any financial goal, whether it's retirement, children's education, or a well-deserved vacation. A bad investment can delay or even sabotage these plans. To minimize the risks of losses in investments, you must thoroughly research the companies or assets you're interested in. Understand their business model, financial fundamentals, and track record. Investing for the long term reduces exposure to short-term volatility. Avoid trying to predict short-term market movements and focus on your long-term financial goals. Also, avoid making impulsive decisions based on emotions like fear or greed. Stay calm and stick to your long-term investment strategy. Another way to reduce the risk of losses is to avoid leverage. And most importantly, invest with a wide margin of safety. Benjamin Graham. Successful investing is more about discipline than intellect. The author of The Intelligent Investor emphasizes the importance of discipline in investing rather than relying solely on intelligence or knowledge. Imagine someone who, like many of us, is not a finance expert but desires to secure their financial future. This person might feel overwhelmed by the idea of investing in the stock market due to the perception that it requires deep knowledge and high intelligence to succeed. Many people can relate to the idea that discipline is a skill they can develop and apply in their financial lives. They may feel that they don't need to be a financial expert to be successful investors. Instead, they can learn to be disciplined in their investment decisions and follow a solid approach over time. Philip Fisher. Buy when, and only when, you are convinced you have found a truly exceptional company at an attractive price. Have you ever wondered when the right time is to buy stocks and achieve superior returns in the stock market? How can you make effective investment decisions? Imagine this. Would you buy a house just because it's on sale, or would you patiently wait until you find your dream home at a reasonable price? In the world of investment, would you invest in a company just because you can, or would you wait until you are convinced you've found an exceptional company at an attractive price? Fisher advocates for thorough research of companies, understanding their fundamentals, their management team, and their long-term potential. Only when we are certain that a company has real value and is undervalued in relation to its growth potential should we consider investing in it. The key here is patience and confidence in our investment decisions. It's not about constantly buying and selling, but waiting for solid opportunities and acting accordingly. Charlie Munger. The first step is the most important. You must be willing to take action, otherwise, no matter how much you know or study, the opportunity will pass you by. Munger emphasizes the importance of decisive action in investing. Imagine you've conducted thorough research on a company and identified a promising stock. You have detailed analysis backing your decision, and you're convinced of its potential. However, you hesitate to take the plunge and buy the stocks. Stock markets are notoriously volatile, and opportunities can quickly vanish. For example, if we look at the average market performance over the years, it has historically shown positive returns in the long term but has also experienced significant short-term fluctuations. Suppose your research leads you to a stock you consider undervalued, and the current price is $50 per share. If you wait too long, and the stock appreciates by 25% in a short period, you would now have to buy it at $65 instead of $50. This can significantly impact your potential gains. On the other hand, if you take action immediately and purchase at $50, even if the market fluctuates in the short term, you have a solid foundation for your investment. Over time, if the company performs well, your investment could significantly increase in value. Peter Lynch: buy a wonderful company at a fair price and then hold it for the long term. This means you should look for companies with a strong track record, competitive advantages, and long-term growth potential. It's not just about blindly buying stocks, but researching and selecting companies with solid fundamentals. During his tenure at the Fidelity Magellan Fund, Peter Lynch invested in a company called Dunkin' Brands Group Incorporated, the coffee and donut chain. The company had a strong regional presence and a resilient business model. Lynch identified that Dunkin' had a strong brand and the ability to expand. He bought the stocks when he considered them reasonably priced. Once you've identified and bought a wonderful company at a fair price, the strategy is to hold it for an extended period, often years or even decades. This is based on the idea that quality investments tend to generate solid results in the long run, and patience is key. Peter Lynch held his investment in Dunkin' Brands for several years as the company continued to grow and expand into new markets. During his ownership, Dunkin' Brands stocks experienced a significant increase in value due to its consistent growth and brand expansion. Seth Klarman: successful investing is a long-term process that requires patience, discipline, and the ability to avoid short-term fads and trends. Seth Klarman's phrase highlights the importance of patience and discipline in long-term investing, avoiding short-term fads and trends. A revealing example of this philosophy can be found in the rise and fall of technology companies during the dot-com bubble in the late 1990s. At that time, many people were excited about seemingly limitless opportunities in the technology market and began massively investing in tech companies without considering their actual fundamentals or reasonable valuations. The stocks of these companies skyrocketed due to speculation and irrational demand. However, investors who followed Klarman's advice, maintaining patience and discipline, avoided succumbing to the widespread euphoria. They focused on companies with solid business models and underlying fundamentals instead of joining the dot-com frenzy. When the bubble burst, many of these tech companies lost a significant portion of their value, but disciplined investors didn't suffer the same losses. Joel Greenblatt: focus on long-term value, not short-term market fluctuations. Greenblatt, known for his value investing approach, used to tell the story of an investment he made in a metal manufacturing company. At one point, after buying the company's stocks, the stock price began to plummet sharply due to a temporary economic recession. Many investors panicked and sold their stocks in response to short-term fluctuations. However, Greenblatt remained committed to his long-term value approach and continued to hold his stocks. Several years passed before the economy recovered, and the market reevaluated the metal manufacturing company at a fair price. When that happened, Greenblatt found that he had gained a significant profit on his investment. Despite short-term market fluctuations, his ability to stay focused on the underlying value of the company allowed him to reap substantial gains as the market adjusted to long-term realities. Mohnish Pabrai: buy when everyone is selling and hold when everyone is buying. The phrase encapsulates a contrarian strategy, which involves making investment decisions that go against the crowd. When everyone is selling, it's usually due to fear or panic in the market, which can lead to a drop in stock prices. At that moment, contrarian investors like Pabrai see an opportunity to buy because they believe prices are undervalued and could recover in the long term. On the other hand, when everyone is buying and the market is euphoric, contrarian investors like Pabrai tend to hold onto their existing investments instead of following the crowd. They know that prices may be overvalued and that market euphoria often doesn't sustain in the long term. They opt for prudence and avoid buying at inflated price levels. Li Lu: avoid the crowd and maintain independent thinking in investing. Li Lu emphasizes the importance of maintaining an independent perspective and not blindly following the majority of investors. This strategy is based on the idea that the market can often be wrong due to the influence of emotions and mass trends. When Lilu advises to avoid the crowd, he means not getting carried away by fads or popular opinions about certain stocks or sectors. Instead of going with the flow and buying what everyone else is buying, he urges investors to research and make decisions based on solid fundamentals and their own analysis. This means being willing to disagree with the majority and having confidence in your own investment conclusions, even when they go against popular opinion. Apply these tips to your investment strategy and start moving towards exceptional returns. Don't forget to like and subscribe for more quality financial content.